This is GameStop, and GameStop is being shorted. You see, ever since 2013, its share price has done nothing but fall in value. Until
GameStop.
What is going on with GameStop stock?
the share price exploded. Enthusiastic retail buying pushed price higher. Shorts were squeezed, causing short covering, which pushed price higher, causing margin calls and liquidations, which pushed price even higher, in a positive feedback loop of intense retail buying and forced institutional covering. But what does any of this mean? How does shorting even work? And what happened in the GameStop short squeeze? Well, I'm glad I asked, because in order to explain it, we're going to have to rewind a bit. The early 2000s was a great time for GameStop. Its brick-and-mortar retail model, selling new releases and buying and reselling pre-owned games, was highly successful. Revenues were strong, and the share price reflected that success. Now, yes, the 2008 financial crisis hit like a pothole in the road, but GameStop wasn't alone in that. The business survived, stock recovered, and by 2013, shares had climbed as high as $56. But as the years went on, the environment around GameStop changed dramatically. Digital downloads replaced physical discs, consoles built in online marketplaces, and fast broadband made buying games from home so much easier. From the outside, GameStop began to look like just another struggling brick-and-mortar retailer. Revenue stalled, stores closed, and the company failed to present a clear plan for moving into the digital age, leaving little confidence in its long-term future. And this uncertainty eroded investor confidence and pushed the share price lower. Now, to hedge funds and institutional investors, this looked like an opportunity, and they positioned themselves to profit from the drop by selling short. So how does shorting actually work? Well, we all understand the basic idea of investing. You buy something because you expect the price to go up. You buy low and you sell high. Well, shorting is simply the reverse of this. You sell high, then you buy low. But wait, you can't sell something you don't already own. You have to buy it first, right? Well, not exactly. And let me explain why with the help of two good friends. This is John.
Hi.
And this is Peter.
Hello.
They're good friends, and John has just bought a new car.
Do you like my new car?
One day, John's phone rings, and it's his boss telling him he needs to work overseas for the next couple of years.
I need to go away. Can you look after my car while I'm gone? Sure.
John jumps in a taxi and leaves. Now, at this moment, Peter starts to have an idea. He knows that cars lose a lot of their value in the first few years, and he expects that by the time John gets back, the car will be worth a lot less than it is today. So Peter does something a bit cheeky. He sells the car for $50,000. Then,
2 years later.
Just before John gets back, Peter then buys back a similar car at the current market price, which happens to be $30,000. So he borrowed John's car and sold it for $50,000, then bought the same car back for $30,000 2 years later, making a profit of $20,000. And John still has his car. Everybody's happy.
Why is it green?
In the stock market, this works in a very similar way. Instead of borrowing a car from a friend, you borrow a share from a broker. The broker lends you the share, you immediately sell it, and you hope that later you can buy it back cheaper and return the share to the broker. The difference between the price you sold it for first and the price you bought it back next is your profit. Or your loss if the price goes up instead. And that's where the term shorting comes from. When you sell first, you don't own the share, you owe it. You're short of the share like being short of change. And until you buy it back, that position is called a short. So why would a broker lend you a share in the first place? Well, two main reasons. First, they get paid interest for lending out shares, in the same way that a bank earns interest for lending out money. Second, many of the shares being lent out don't actually belong to the broker. They belong to large investors like pension funds, ETFs, or institutions that hold shares long term and are happy to earn a bit of extra return by lending them out. Now, this brings us on to an important concept: the share float. A company has a fixed number of shares outstanding, but not all of those shares are actually available to be traded. Let's take GameStop in the late 2020s. At the time, GameStop had roughly 70 million shares outstanding, and of those, around 10 to 15% were actually held by insiders, like executives, directors, and large early investors. These shares are generally considered locked up and not part of everyday trading. That leaves roughly 60 million shares in what's called the public float. But here's something to note. A large chunk of that public float wasn't sitting in the hands of active traders. Roughly 40% of it was held by institutions, index funds, and long-term investors, funds that don't normally buy and sell every day. So even though those shares count as part of the float, many of them weren't really available in the active trading pool. Oh dear. Which brings us nicely back to GameStop. Now, where were we? Ah yes, price had gone down and down while short interest had gone up and up. Right up to the point where the price hit a low of $4 and short interest hit its peak with 140% of the float being short. 140%! That's more shares owed back than actually existed for public trading. How's that possible? Well, let's pop back and visit Peter and John. When John lent Peter his car, and then Peter sold it, he sold it to a buyer, and there's nothing to stop that buyer then lending his new car out to someone who also sells it. Now you see where I'm going with this. Same car, but now we have two people who will need to buy a car and then return it to the lender at some point in the future. The same can happen with shares. They can be borrowed, sold, then lent out again and again and again. And on paper, one real share can support multiple short positions. It's legal and it's normally fine as long as things don't get out of hand. Enter Boring Kitty. Well, his real name is Keith Gill, and there's something that he got very right, but also something that he got very wrong that no one seems to talk about. Kitties can't roar. He was wrong about that. Naughty boy. But did you know something he wasn't wrong about? GameStop. He didn't see a dying retailer. No. He saw a recognisable brand, a fiercely loyal customer base, and new management with something to prove. But most of all, an absurdly high short interest. So he posted his thoughts on the internet. More specifically, a Reddit group called Wall Street Bets. The idea was simple. If enough people bought and held, short sellers wouldn't just want to buy back, they'd be forced to, at any price. And to understand why, we need to understand two things. Liquidity and margin. But to fully understand market liquidity, you first have to understand the mechanisms that make price move. You have to get behind the price. Because behind the price is an order book. Now, I've already covered this in a previous video, but here's a quick recap. The order book is just a list of limit orders, organised by price, waiting to be filled. Waiting because on their own, they can't move the market. For that, we need a market order. So let's mark it by 10 shares. And the order starts by buying the cheapest available offer on the book, and that's $21. So one share is bought here, then 3 at $22, and then there are no sellers at 23, so price moves to 24 and buys 3 shares, then 2 at 25, and finally 1 at 26. So we have our 10 shares for an average price of $23.50. You can now see that the listed price of the stock is $26 because the listed price is just the last traded price, and it's sometimes just called last price. But because no buy limit orders had filled in as price moved higher, the liquidity below the price is, well, non-existent. So we try to sell and price jumps down to the highest buyer and we end up getting filled all the way down to $13 and realising a loss of $76. That's not great. Well, let's now increase liquidity and buy 10 shares again, and all 10 shares get filled for $21 and price doesn't really move. Liquidity is simply the term that describes how easy it is to get in and how easy it is to get out without moving the price. But liquidity is relative to order size. So even at this higher liquidity, let's see what happens to price when we mark it by, say,
1 million
shares. When the order hits, the order book gets eaten up and the price has to climb higher and higher looking for sellers to buy from. And it will keep going up until the order is filled or there are no sellers left. Well, if you're still unsure about how the order book works and want to have a play, then this order book is actually a simulator I've made. And the link is in the description. It's kind of fun. Now, margin is basically just a safety buffer that protects brokers from bad decisions. And just like any lender, a broker wants collateral to cover that risk. A mortgage lender wants your house, a loan shark wants your kneecaps, and your broker wants account margin. Look, you don't have to do this. You know they're good for it. You know they are. They're going to like and subscribe. You are going to like and subscribe. They're going to do it. If you buy a stock, go long, hoping the price goes up. The worst case is simple. The price goes to zero and you lose what you put in. But short selling is a little different. When price goes against you, up, there's theoretically no limit. Price can just keep going higher, which means that theoretically losses can exceed your account balance and you end up owing the broker money. Now there are two simple mechanisms that brokers use to prevent this from happening. Hopefully. If price moves against your position enough and your account equity drops far enough, first you get a margin call.
Back in the day, that really was a phone call. Your broker telling you to add more money or close the position.
These days it's usually just a notification on your screen. Now if you don't act or price moves too fast, your equity can fall further. Then eventually the broker liquidates the position, they force it closed. And when you're short, that means buying the shares back on your behalf and you take the loss. Remember what we said earlier? GameStop didn't just have high short interest, it had 140% of the public float short. And thanks to intense buying by Roaring Kitty and his internet friends, the amount of available shares for sale was dwindling. Sell-side liquidity was getting increasingly smaller, with a huge number of potential buyers in the form of short sellers. So now we have all the ingredients of what happened next. Price crept higher and closer to the margin requirements and risk limits of some of these large short positions, and it took just one large position to buy back to cover their short, and in doing so they vacuumed up what little liquidity was left, causing the price to spike higher, causing a fresh round of margin calls and forced short covering, more buying, which pushed the price even higher, causing more retail hype and buying, which triggered even more margin calls, which forced even more buying. It was a chain reaction that ultimately inflicted massive losses on hedge funds. Melvin Capital lost over half its value and needed a multi-billion-dollar bailout before eventually shutting down. Citron Research took a total loss on its short position and abandoned short selling analysis entirely. D1 Capital lost around 4 billion, and other funds like White Square Capital and Light Street Capital suffered heavy damage. Altogether, short sellers lost around 20 billion during the peak of the squeeze. And the reason it happened wasn't magic, it wasn't manipulation, and it wasn't even really about GameStop. It was about structure. A stock with shrinking liquidity and an unusually large number of short positions that would eventually have to buy their shares back. So in the end, the mechanics of short selling, unlimited downside, margin pressure and tightening liquidity were the fuel, and Roaring Kitty and his merry band of Wall Street bettors were the spark. They didn't create this situation, they just took advantage of smart money being really dumb. Oh, what am I doing? You better like and subscribe. Thanks for watching.